This is a simple IUL design for a 60-year-old with $500,000, considering IUL as a vehicle for his retirement. Let's take a look. Very first thing here, I will pop it up on the screen, but I have to state this is only hypothetical, does not represent any insurance company or actual IUL product. This is intended to be for educational use only. Please consult with a licensed professional to acquire an illustration from an insurance company. All right, so let's get into it. We are simply going to be over. If you are 60 years old, what would it look like if I were to put 500,000 into an IUL, move that over and start taking income right after that 5 years is up? So you fill it with 500,000 over the course of 5 years. You start taking income right away in year 6. How much would that be? What would it look like? If you want more details of how the IUL actually works, how any of this is possible, I have that in other videos. This one is meant to just be real simple. Look at the numbers and it'll get out of your hair. So let's go ahead and do it. You can see here I put the age is 60. The simulation years is 41 to go till age 100. I'm going to put here, we're just going to assume the money is going to grow at 7% on average. That's after fees and everything. Money's growing at 7%. Again, hypothetical, but that's what we're going to go with. We're going to say you're going to put in that 500,000 over the course of 5 years. So this is $100,000 5 years in a row, and we are going to start that income right away in year 6. So we filled it up, age 60, 1, 2, 3, and 4, and then age 65, we want to start taking income. We're going to say we're going to loan that money out at 6%. So it's growing at 7, we're loaning it at 6. Again, just hypothetical. And since we have that 1% spread, as opposed to maybe the 4% rule where we can only take out 4% at a time. Of course, some people disagree. You can maybe do more with different strategies. But in this case, we're actually able to take out a little bit more, not only because we have the floors in place with an IUL, but also we're getting a 1% spread on money we've already taken out, which can of course be helpful for increasing your net spendable income. Let's take a look. All right, here we are. So we have the 100,000 under the premium column. That is where our money's going in. You can see we put that in for 5 years, and then we start to take our policy loans. So this is what would be your tax-free income. Government knows you're receiving it, but it's not going to be showing up on your 1040 tax return. The loan balance, of course, is staying about 6% ahead. Why? Because we set the illustration to loan at 6%. The accumulation value is growing at 7%. So even though this loan balance is growing, and you might think, oh dang, that kind of loan balance makes me nervous, we do still have this accumulation value that's growing 1% ahead of that. And that's why, even though, we're getting 7% on right here, for example, this whole 934,000, well, we're actually also losing 6% on this 584. And how much money we actually have access to, that's what's reflected here by the surrender value. We can see it again if we just continue down the years. In this simple basic illustration, see here, it's the $41,802 that they're taking out tax-free each year through age 100. If at any point you die, you of course have the death benefit amount there. So if you passed away right after putting the first 100,000 in, well, you wouldn't have to put the next 400, and the 1.1 would go tax-free to your beneficiary. Same thing as you kind of come down the years here as well. You can see if at any point something were to happen to you, whether you're age 75 or age 91, there is still that death benefit. It's usually about 5% ahead of the money you have access to. So you have access to 99,000, but if you passed away, they get a little bit of a bump. So kind of a nice little benefit there. And of course it's tax-free because it's insurance. One thing you want to pay attention to here is you can see right after year 5, right when we start taking this income, the death benefit drops to the minimum. Now this is going to be something you want to notice in every single policy, is you're always going to want to reduce that death benefit to the minimum when you're done contributing. Now, sometimes this varies a little bit in specific cases, but in this one, for example, if we just left the death benefit, say at 1.5 million, and we let this grow, well, we're paying for a little bit more insurance, which is fine if you want to do that, but just know your policy isn't structured optimally, to where in this case, we reduce the death benefit to the minimum. We have the least amount of insurance possible, so most of our focus here is on the cash growth. We're going to continue to maximize our dollar we get while living, as opposed to what goes to our heirs when we pass away. And lastly, before we end, if you were wondering, well, wouldn't that other 400,000, like as I was putting it in over the 5 years, have also grown a little bit? I ran a little thing here, so you can see, I basically put, let's assume that that 500,000 is in an account that's gaining 5% on average over those next 5 years before we kind of put it all in. What would that actually look like? So again here, I have it growing at 7%, loaning at 6%, and here's what we came up with. We can see, hey, we're able to put in a little bit more than the 500,000. Why? Because it was growing a little bit over those years as we were waiting to put it in. And in that case, you see here our policy loan amount actually turns out to be a bit higher. So rather than taking the low 40,000 number, you here are taking the 48,000 a year. Again, all a hypothetical, but hopefully that clears up some things and kind of shows you some of the nuances within IUL. Again, if you really want to look into the specific nuances and what it would look like for you, what happens if the market goes down a few years, do I have to restrict my income? All of that stuff, all great questions, all stuff that there is software to go over. And it's just important to know before you get into anything like this. But as always, if you are wondering kind of what that would look like for you, click the link below. I'm happy to. It's a free 20-minute consult. Happy to kind of go over what it would look like for you, if it would even make sense, and what that income could look like for you in retirement. But otherwise, subscribe, and I will see you in future videos. Bye-bye.